So hi, everyone. I want to introduce you to John Zolidis. John actually lives in Paris, and I'm really looking forward to asking John about how that happened. But he lists himself as having come from Southampton in the state of New York. He studied in the United States at Kenyon College, but he's also got a degree in philosophy and German literature from Oxford University, which is also something I'm planning to ask you about, John, and studied undergraduate at Kenyon College, which I'm now starting to hear about because my daughter is applying to American universities. And other than that, John has, in his professional life, John has worked as a research analyst, a stock equity research analyst at two firms, Sidoti and Company, and then at the Buckingham Research Group, before starting, I guess, Quo Vadis Capital, and living in Paris. So I guess I'll stop there and say, John, how did I do with my introduction?
I think it was great. Thank you. There were only a few modestly false things said, but you know, I think the general gist of it was fairly representative of what I've been doing.
And for what it's worth for the listener, John has been attending ValueX for quite a while. But I have not really had the opportunity to sit down and talk to John one-on-one, just because every time I'm at ValueX, it's a bit like it's my wedding, and I have all these lots and lots of short conversations. What I have been able to benefit from are John's presentations, but perhaps you can share a little bit about how you ended up at ValueX, actually.
It was through the value investing global network, if we put it that way. I had, I think, originally got involved and introduced through Vitaly in Val, and I had called him up perhaps because I had found myself on his email distribution list, and I had an idea, a stock investment idea that I thought would be interesting to him as a value investor. So I called him up and we discussed the idea. I arranged for him to speak to the CFO of the company, and he ended up purchasing the stock and making money in it. At the time, he said it was the first and only stock he'd ever bought as a recommendation from a sell side analyst. And later, he then invited me to his conference in Vail, which exposed me to Sophocles' Antenna, who then later invited me to Cyprus, where I was very happy to go. And then I believe it was through that circuitous route that I ended up coming also to Cloisters.
Yeah, that's so cool. And for the listeners' interest, Vitaly Katzel-Nelson has become so famous that we just have to say Vitaly, and we all know who we're talking about, which is funny. It's also interesting for me, John, that it seems that new technologies took what were big conferences, and the most famous one was the Value Investing Congress, which was run by John Schwartz and Whitney Tilson. And they had big name speakers in places like Pasadena, but also New York City. And somehow those don't happen anymore, but there are all these kind of far smaller events. And each event has a personal stamp of an organizer, but there are groups of people who come to these events and perhaps get more value out of those smaller events than the bigger events. And it's kind of fun to be a part of that. Tell me and us about the transition from Buckingham Research to Quo Vadis, and also the transition between the Northeast of the United States and Europe.
Okay, so those are two separate but interconnected topics. In the case of starting my own business, I found that it was challenging to find a firm where I could do the kind of research that I like to do and speak to clients in a way that would add value to their process. I believe that the sell side business as it was constructed was impaired from a lot of structural reasons. But I actually do like creating research. And so the question was, if I remove some of those structural constraints, can I solve for the problems that are impairing the value of people's research process and create a product and a service that actually adds value for my clients? So that's what I set out to do by going out on my own. I also wanted to become a registered investment advisor so that I could manage money for individuals, which is something I'm doing as well as creating stock research. And when I was doing that, I was living in New York City. And as I like to put it, the cost of failure in New York is very high. So I felt that it would be better if I could do this in a lower cost jurisdiction. Now, some people are surprised to learn that Paris is not that expensive. I have some theories about why that might be. Now, this is a relative not expensive to London, for example, which I think is the first place most North Americans think about when they think about Europe as a place to live. I would say London, in my view, is more expensive than New York, but I think Paris is about half as expensive as New York for a variety of reasons. So I wanted to move to this lower cost jurisdiction. My wife happens to be French. I wanted to put my daughters in high school in a French speaking or international environment. And, after more than 20 years in New York City, I was interested in trying something different. I like living abroad. I always have liked living abroad. So this was my opportunity.
And so you picked Paris. Can I ask? And your wife obviously is very, presumably she likes being in Paris. She's originally from Paris, or?
Yes, she's Parisian.
Yeah. And if I, this might not be interested to the listener, it is to me, where in Paris?
Well, I mean, you chastised me the last time we spoke because I had moved across the river from the left bank to the right bank. So now I'm living on the 8th most of the time, although I'm still back in Southampton, New York, also quite often.
So, yeah, and for the listeners' interest, I lived for about 1.5 years in the 7th arrondissement, which is on the left bank, and I just love the 6th arrondissement, which is right nearby. And there's a place called Au Bon Marché, which is owned by Louis Vuitton. And there's a cafe called Les Deux Magots. And I can spend endless hours just going around there. And I actually just organized a retreat for some friends there, and they loved it as well. So just briefly, Southampton, for your interest, John, Southampton, for those of us who lived in Manhattan, was one of the retreat places where one would go to. And Southampton was special because it still has a Italian coffee joint called Sant'Ambrose, which I'm sure you're familiar with.
Sure.
And I was there actually not long ago, and there's a shop that sells, I think the shop's called Sea Breeze, and it sells some cotton t-shirts of the highest quality. For you, Southampton is home, I understand.
Yes, when I'm in the US, that's my home base.
And the whole of Long Island is a very unusual place because it's an island on the east coast of the United States. It's a historic island in that some of the earliest settlers, European settlers, came to Long Island. But it is strange because the only way you get by land from Long Island to anywhere else in the United States is via New York City. If you can't really kind of get anywhere much, maybe via highways, Verrazano Bridge, but and it's this also strange geologically because it's this undulating spit of it's a sandbar effectively. Could you just briefly share what it's like to call that part of the United States your home, as opposed to having perhaps being from New Jersey or Connecticut or Northeast in general?
Okay, well, I did go to high school and grow up in Wisconsin. So that's about as far away from this environment as you can imagine, in that I don't think I had ever seen the sea before later in high school. And I think the defining characteristic of being out on the end of Long Island is the ocean and the beaches. And the beaches are very untouched and pure, and it's quite therapeutic to go walk on the beach in the morning. I would try to go like every other day just to have a cup of coffee or something, even if it's only for 5 or 10 minutes. I find it's really powerful. Aside from that, there are some positives and negatives, as there are with any sort of place. It is a very seasonal destination, and during the summers, it can get a bit overrun by people coming out there. I actually prefer it in the off season I find it a little bit more authentic. I like being out in the woods. It's easier to get into a restaurant. You don't have to wait in line, etc. So it changes throughout the year. It's a very relaxed place. The light can be really amazing because the sun reflects off both Long Island Sound and the ocean. But also you get in the night, sometimes if it's a dark night, you literally can't see at all. You can see nothing. There's no light pollution because of the same effect. So it's an interesting natural place. And I think that has an effect on how you feel when you're out there. It's certainly a strong counterpoint to New York City and all the noise and stress that comes along with the urban environment. It's a nice place to be and a good place to relax. You can get work done there, and you can also just goof off.
Yeah, it's a very special place, and I have to say that the beaches there are kind of it's an area of extraordinary natural beauty. It's quite shocking to see how close it is to New York City, actually. And you're absolutely right that the kind of the summer exodus from Manhattan kind of spoils it a little bit. And I agree with you that the times I visited in the off season, it has just a very, very special quality to it. Many visitors to the United States have only been to places like New York City and are not perhaps aware of some of the other places not far away. In any case, so you just mentioned that there were things that you saw were problematic with the way research was done. I presume that you kind of referencing at least some of your experiences of Buckingham research. And I'm curious to hear what that is and how you sought to rectify it at Quo Vadis.
Well, there's a myriad of conflicts of interest, which really impair the research process. So I think in the past, I talked about a number of different things. So one is there are too many masters for the research. So when you're creating a piece of research in a traditional sell-side environment, you need to make it so that it's digestible by your sales force, that it is not offensive to any management team, that it fits within the format that your firm deems is appropriate and can be distributed via email. And then also you cannot write anything that may be offensive to your clients. And in this case, because clients compose all of the buy side, that's every hedge fund, every mutual fund, every pension fund, there's pretty much a possibility of offending somebody, no matter what you say, if you have a strong opinion. So when you're trying to backtrack to avoid all of these sensitive parties who are receiving the research, you're already set at a disadvantage. Secondly, there's a format problem, which is that the format, including the language that you're allowed to use, is somewhat controlled by regulatory process. So there's certain kinds of things you can't say in research. It has to be certain things you have to include in any kind of research report. And so as a result, you are constantly being curtailed as well in terms of your thinking process, which you would normally want to be unfettered to arrive at the right conclusion. In addition, there are certain things like if you believe that your estimates are too high or too low, and you are actually required by regulatory reasons to publish an update to that when you arrive at this conclusion. Now, perversely, this actually works against the estimates being updated because analysts don't want to create extra reports changing their numbers by a nickel. And so they avoid changing their estimates so as that they don't have to publish a note. And then the other bigger problems are that that research is generally over-distributed. So in the case of my prior firm, but this would apply to really any firm, if, for example, I had actually come up with some really exciting, differentiated, insightful research and done great background to back it up. If I were to go out and publish that, it would go to 2,000 people. Now, perhaps only 10% care and half of them look at it. But even so, if you were to get that many people to look at a comment that you made about a business, it would have the effect of immediately changing the price of the stock in the market and adjusting the expectations for the company's performance, which results in destroying the value of the research you've created. So for Quo Vadis, what I'm doing instead is I do not publish my estimates, which relieves me of this requirement to update and publish something every time I change a small number. Therefore, I can keep my estimates as accurate and up to date as I think as appropriate. And then I only share my product with a really small number of clients. And my objective as an analyst is to figure out when the sell side is wrong. So I'm trying to solve for when the embedded expectations in a stock are inconsistent with what I think the company is likely to do. And then I want to preserve that value for my client base by sharing it just with these small number of clients, and thus not affect the embedded expectations in the equity value. And then I think the last issue with the sell side research is that frequently they have no actual process to evaluate companies. They don't have any special insight or differentiated approach to evaluating the businesses. So what you get is a lot of earnings previews and reviews, which generally repeat what management teams have told them and are distributed in a way so as not to upset any of the various constituencies, be it internally within the firm, being it the sales force, the traders, or the clients or the management teams. And so you get a very kind of gray, neutral-ish type product without a lot of insight or opinion. Now, certainly that's not true of everyone. There are a lot of really great, talented analysts out there who do interesting work, who have a process, who have opinions, and have stuff to say that I think is worthwhile listening to. But the vast majority of it is Me Too research, which is impaired by these structural issues. So I felt that for myself, the only way to create research that was really going to help was to get outside of this structure, so that I could then go forward and try to create product that would create alpha for my clients.
And one thing that you haven't talked about is the compensation model. And I'm aware, for example, Sidoti is a classic brokerage firm where they would distribute their research selectively to the highest paying clients who would pay via brokerage commissions on turnover of shares traded. I'm curious, you haven't talked about that. I don't know what the business model was at Buckingham, but does any of that, I mean, can you just enlighten me and anybody who's listening
Sure.
in on the compensation models?
Yeah, so I'm glad you asked that question. That is another issue with the broker-dealer model, is that it's typically paid for with trading. So what that meant is that when we were creating research, and things have changed now, it's not as much that way today, but the idea was it needed to be a saleable idea. That is, we want the client to buy or sell the stock, and
Right.
we want them to do it on our trading desk. And it's interesting, if you think about the rating system that analysts use for stocks, it's still rooted in this broker-dealer action-oriented approach. So you see analysts have a buy or a strong buy or a sell. So I actually changed my rating system. My rating system is long and short or no call.
Right.
So I'm not necessarily telling you that you need to buy it right this second. It's just a stock that I want you to own, or a stock I want you to be short, or it might be a stock that I just don't have a strong view on at this time or another. So it's not about getting you to actually do something right now, because the reality is that a buy side person who's running a fund, and you can tell me if you don't think this is right, doesn't buy or sell a stock or a position all in one day. He or she may move into a position over a period of time, buying tranches of it at higher or lower prices, depending on what's happening in the market and their level of conviction, any new information that comes into play. So for my model, I'm using a subscription subscription-based service. And the idea is that you don't want me to be calling you up trying to get you to transact. What you want me to be doing as your outside analyst, I consider myself like an outsourced buy-side analyst, is doing the best research that I can to help you. So you want my time is best utilized by digging into more financial statements, building financial models, talking to management teams, getting out there and going to conferences or trade shows. It's not about finding an incremental idea that you should be buying or selling on any given day.
It seems to me that if I think back 20 years, I mean, the structure, I have never been what I was, I guess, on the sell side for a short while, but so everybody's now a fundamental investor. I don't know if you're not a fundamental investor, you're a quantitative trader, and that quantitative area is just a whole kind of like ball of wax that one either has to live 100% in that world or not live in it at all. But all of the kind of momentum investors, growth investors, those have all gone away. And it seems to me that if you were a brokerage firm that wanted to generate trades based on, or trading volume based on these kind of short-term ideas, that anyway has gone away because none of that's going to fly. I mean, there used to be a role called sales trading. And as I understand it, what sales traders would do is they'd call up portfolio managers and give them some story, some saleable story about what's going to unfold in the next 3 days and would they like to trade around their portfolio. And so all of that's disappeared in a certain way. But are there any firms left that compensate their research based on shares traded with their clients?
Yes, the answer is yes. It is somewhat complex. Some things have changed. I mean, there are very few actual people putting in trades. In the past, there would an actual person would work an order over a period of time if it was a larger order. Almost all of that's gone to electronic trading, although there still are people doing those, especially for larger orders in a more bespoke manner. But I would say that the volume, like there still are short-term trading oriented investors out there. And many times because they're so active, they drive much higher commission pools. And so research must be created to serve this client base. And so I'm thinking in particular of market neutral hedge funds. So in these cases, these very large pools of capital are looking to produce 1 or 2 percentage points of alpha every month by being long and short stocks in the market, and they're playing mean reversion, they're playing pair trades, and so they're very active moving in and out of their positions based on short-term factors and considerations and catalysts. And so those are very much still out there, and research and analysts do spend time speaking to those clients because they're large commission payers.
And so, on your website, there are a number of presentations and other research reports. Obviously, those are not everything that you produce. I'm curious. So just for clarity, I'm not a client of John's, but I do get to benefit from his wisdom and insights at the ValueX conference. Do your clients, your paying clients, are they there because they want to read your research reports or because they want to talk to you?
That's a good question. I mean, I think it's both. I mean, the point of the communications I make to the client is to get my ideas to them in a timely, concise, insightful fashion. So when I start in the morning and think about, okay, what am I going to communicate to my clients today, which is not every single day, but at least once a week, I'm writing about what's happening. I try to think to myself, what can I say about this business or the stock that isn't obvious? How can I add value and have some insight into what's happening at Dollar General or Target or Walmart or Chipotle that my client doesn't already have? And I acknowledge that they're already getting tons of free research. And they also get frequently credit card data and very short-term oriented data related feeds on what's happening with businesses. So for me, I start with, okay, I'm not a data guy. I'm a fundamental bottoms-up structural analyst. And so I try to find something that's going to complement the data that they might have. So And then, I do want to talk to them, but these guys, in the most case, my clients are overwhelmed with calls and emails and things coming through, as well as just the mental discord of all of the stock price movements during the day that they're supposed to stay on top of. So I do try to speak with them when I can, but sometimes it's they're really occupied, and so I try to create a piece of research that is impactful and differentiated, that will lead to incremental conversations, so I can act as a trusted advisor. That's really the role that I'm looking for.
And I guess I in some levels, I've got this back to front, but I can ask the question now. So you specialize in the consumer sector. There are many retail stores that you've covered, and the retail mindset, or the individual consumer's mindset. Can you tell us the story a little bit of how you ended up there, as opposed to any one of the many places that you could have become specialized in?
Sure. So it's been really accident, but it was a happy accident. So when I had my first job on Wall Street as an analyst, I started at Sidoti & Company, which you mentioned, and Peter Sidoti is still a good friend of mine. And they basically had a model where they brought in younger people and allowed them to learn. I like to say learn by falling on your face, which for me turned out to be a good way to learn. And I was actually the first person that they hired as an independent firm. And they gave me a stock to review, which was a company called Piercing Pagoda. Piercing Pagoda was later acquired by Zales, which was later acquired by Signet. Piercing Pagoda sells lower priced jewelry in kiosks in the mall. Now, this is a consumer company. There are actually, you may not be familiar with this, but there are fashion trends within jewelry, even at the lower end. And so a company like Piercing Pagoda, their need was to stay on top of what their customer wants to buy, what kind of earrings and necklaces and et cetera, that they're getting, get the right product in their merchandise, the store. And so my job as an analyst then was to calculate the return metrics of these stores in the mall, which were actually quite attractive, and understand what was happening with the business. And I went from there to following more apparel. I did more apparel names and footwear, including one of the first stocks that I followed was Steve Madden, right before Steve went to take his time off in federal prison, as was shown in The Wolf of Wall Street. And it turned out that this was a very good sector for me because it combined the quantitative component with a qualitative component. And I'm neither a left brain or right brain person. I have a skill set which includes both. So this was really great for me because I felt that from a client standpoint, some clients are very quantitative and some are very qualitative, but it's hard to have both of them together. And that was what was required to follow this space, especially fashion.
Yeah, and the retail sector has gotten a pretty bad rap over the last, ever since Amazon showed up on the scene.
Sure.
And it's kind of interesting. I mean, in a certain way, I figured out probably 20 years ago that unless it was a blockbuster brand like McDonald's or Chipotle, it was an extraordinarily difficult sector to follow. And there was actually, I sat in on classes, you might enjoy this, of Joel Greenblatt. And Joel Greenblatt's sister gave some of the guest lectures at the class. Her name is Linda Greenblatt, and she ran a fund focusing on the retail sector. And one of the things that she would say is that she was very diligent and interested and active shopper. And so she had a deep interest in that qualitative side of things, which allowed her to foresee trends before they actually came up. And it's amazing because you talk about retail as a franchise, and that there'll be a company that will develop a whole line of clothing dedicated towards plus size women or some other kind of sector. And then it's kind of franchised across the country. And then people like Linda or John figure out trends before the markets figured it out, and you can make enormous amounts of money or lose enormous amounts of money. And I always found it, other than the kind of the big blockbuster brands, I found it, that kind of ethereal nature of the retail environment to be extraordinarily difficult to want to engage with, but somehow you wanted to engage with it. If a conversation between you and me 15 years ago, what would it have sounded like when I've just said that? What would you have said back?
Well, I hear that many times. This is not the first time that someone has expressed some concern or difficulty with regard to the sector. With looking at retail, you can segment it further into different spaces. So if you're going to talk about apparel retail, that is a very specialized, difficult, as you mentioned, ethereal, trend-driven space. And the analysts that typically follow that space are in the stores all the time. You need to be in the store at least once a month. I would drive all around New Jersey, going to every shopping mall. Every time I was on a business trip, I would take an extra half day to visit stores. And you would look at what were the markdown levels in the stores, how is the product being presented, try to find out like if the product's selling, are there unplanned promotions? And it was very quick and it could turn quite fast. The other thing that was difficult to understand, I think, for investors in the apparel space is the longevity of trends. So a fashion trend might be one season, but it might last 7 years. And so I'm thinking of, for example, Abercrombie and Fitch. So, and I would describe their trend as the distressed Americana. So it's kind of this like beaten up college kid, overtly sensual look that was really hot for a long period of time. When they opened up stores, when they had this huge store on Fifth Avenue, every kid that was visiting from France or the UK would wait in line, and they would to get inside to that store, which was enormous. But then when those trends,
my office used to be just off the edge of, so I used to have an office on West 55th Street.
Okay.
And it blew me away, the lines of people outside from all over the planet, as you would say. And these kind of like salespeople / models who all seemed to be dressed, it was like kind of the sensual side of it was kind of like almost overwhelming. And they had this scent in the store that was also unmistakable. And by the way, John, one of the reasons why I made myself go inside the store was, first of all, my sister's children at the time had to visit the store. But also it was a stock holding of Ruane Cunniff. And it was amazing for me because Ruane Cunniff, I enormous respect and admiration for their firm and their stock picking ability. And there they are buying this retailer. But what is sort of shocking to me now is that I mean, I really haven't followed the company, but I don't know how it ended effectively. That whole trend ended, didn't it?
So it did end. But what happens is that when something is in the third year or the fourth year, it becomes a narrative that the company are merchandising geniuses. And so that tends to justify higher and higher prices for the stock and higher valuations as analysts attempt to continue to justify recommending the shares. But then a lot of times—
And by the way, just to add to your narrative, is that in that period, with all the people queuing up in front of the store, you say these guys are merchandising geniuses. Well, obviously, the person who says that is obviously a genius because he recognizes the genius of the merchandising geniuses. So if I'm some analyst and I say that, everybody nods their heads in solemn agreement. So there's this kind of like self-reflective effect that's going on between the success of the stores and the way people talk about the business. And then the ultimate, John, is that Harvard Business School comes out and writes a case about how brilliant the management team is. When Harvard Business School comes out and writes a case about it, now you know you're at the top. And perhaps, who knows?
I mean, another company that I followed that you may be less familiar with is a company called Chico's. FAS Inc. And that was one of the first names I started following it, I think in 1999. It was probably a 400 million market cap company at the time. And they had a trend they aimed at baby boomer women, and it became super popular. And I think at one point it was one of the top 10 best performing stocks on the NASDAQ over a 10-year period. So it had just compounded. The problem was they built 500 awesome stores, but then they didn't stop. They built another 100 stores. As the trend started to roll over, the customer got bored with it. The merchandisers started to miss their mark. The look became too ubiquitous among the customer group. And then basically the whole business collapsed and the stock went from, I think, $40 a share to $2. And I think it still trades in the single digits today with margins that are, not very attractive. So you're right to be hesitant towards this space. It's a very difficult space. You have to be really on top of what's happening from a fashion perspective, which is, again, that qualitative side of the analysis. But there are also exceptions that become super powerful names like Lululemon. So Lululemon is also a specialty apparel retailer, but they have just been able to continue to drive engagement with their guest and also to have the brand resonate on a global basis. So it's working in Singapore, it's working in China. It hasn't worked so much in France, where people don't generally wear athletic clothing outside of doing athletic activities, which is what Lululemon is really servicing, is this athleisure trend. Maybe it will end someday, but it has already lasted much longer than I thought it would, and that's credit to them.
But then you have, so bringing up another sports brand that at the time that I lived in New York was going from strength to strength is Under Armour. Yeah. And I think that Under Armour's just hit a few road bumps, hasn't it?
Under Armour's had several problems. My view is that they were never really as innovative as they needed to be. So their primary innovation was to bring out what they called technical athletic fabric. And they do get credit for this, but really the fabric was polyester. So it was something that was, I think it must have been invented in the 30s or 40s, which they repurposed for athletic use and then put great marketing around it, showing that how this product performed much better than cotton. So it had sweat wicking properties and cooling and whatever. And I think it's true, it did have all those things. And by the way, this is one of the ways I used to I explain how fashion trends work to a client who might not be that fashionable themselves. So I would say, hey, when I graduated from college, I used to go running in Central Park, and I would just be happy wearing any old t-shirt that I had lying around in the bottom of my drawer. But then, after Under Armour came out and everyone upgraded to these special fabrics, I felt that if I didn't have some fancy sweat wicking fabric, that I was just really a pretender and I shouldn't even be out there at all. It's embarrassing. Now, why would I think that when I'm just taking a jog and throwing the clothes directly into the wash right after? It's because of fashion. So fashion gets into your head and influences what you want to wear, even if you're only vaguely aware of how it might be out there in the world. So these are true things. They're real. They drive trends. They drive a lot of purchasing behavior by consumers. There can be powerful investment theses around things like that.
Yeah, I mean, for what it's worth, from my perspective, I think that what my awareness of Under Armour is that they were kind of the anti-Nike, in that if you were a kind of if you wanted to demonstrate to yourself more than anyone around you that you're a serious sports person, then you would wear Under Armour, because that was kind of the idea that you kind of like own something that where they're spending the money on making the best possible product rather than spending money on promoting the brand with famous athletes. And so serious athletes wear Under Armour. Athletes that are influenced by famous sports people wear Nike. And so I don't know if you want to react to that, if that's just me in my little head, or.
Um, so they were innovative around this fabric, and for a while, the marketing associated with that was really adopted, especially by a maybe a 12 to 18-year-old male customer. So they really owned that customer for a while, which was a big threat to Nike, which was previously dominant in all of these things. But to answer your earlier question, and maybe sidestep a little bit, that's the second question just asked, but I can come back to it. I think what happened is that they just didn't innovate from this base. So while they came out with these interesting fabrications and had a great marketing message around it, there wasn't really anything behind that. So they had a hard time kind of backing that up. And in addition, they eventually over-distributed their product by selling it to too many retailers outside the dedicated athletic apparel and footwear space, which cheapened the brand in the eyes of the consumer, and perhaps therefore hurt their authenticity and their credibility with that athlete consumer that you just referenced. Meanwhile, Nike is really one of the most incredible companies I've ever encountered. And when I say that, I mean from a product, a branding, a financial standpoint, a distribution standpoint. They are so impressive that trying to compete with Nike is extremely difficult, and few have succeeded.
Yeah, just to go to one of the other points that you made, it took me a while to get there, and I'm always shocked at how few people of my ilk get there, in that they really don't understand the power of the money that is spent by a brand on influencing their consumer mind. And many people who are analytical will say, oh, that stuff doesn't influence me in the slightest. And what I want to tell them, if I have the time, is, you don't realize the degree to which that stuff is influencing you. It goes so deep into your subconscious mind. And two brands, obviously Nike is just, and in some cases it just seems to be luck, because or maybe it's not luck. The Nike logo works really well close to an image of the person's face, works other places as well. What comes up for me is the famous golf shot that Tiger Woods took, where the ball rolled so beautifully into the hole and the Nike logo was just there. But the emotion, the face and the emotion in so many different circumstances. The Reebok logo clearly did not work as well, and the Adidas logo is kind of not the same thing. It's just a different kind of logo, and Nike's exploited that in 1,000 different ways and has transformed whole categories. And I can say that, becoming aware of that, I know that I have a slight preference for Nike wear gear, because is something about the all the built up perceptions that I have about what a Nike athlete is, from adverts of women going running, just do it, to Tiger Woods, to various other athletes that I'm aware of. It inspires me to want to be a better sports person when I wear the Nike clothes, which is your point. But another point that I try to make to people is that also happens around luxury watches.
Yeah.
And many of my friends try to convince me, or believe very strongly, that luxury watches are all those manufacturers are about to go bankrupt. And I kind of say, the ultimate there is Rolex, whose advertising is so ubiquitous and so well done to create a brand perception around Rolex watches that people are just unaware of, until you realize how many people are wearing Rolex watches on their wrists, and somehow it has influenced their purchase. I'll be curious to sort of like go into the luxury goods business, or luxury brands, luxury products business, because you're at the very center of it in Paris. But what your point is, that in retail, even when you're not talking about Nike, even if you're talking about some apparel brand like Chico's or Abercrombie and Fitch, these factors are at play in a massive, massive way.
So I wanted to call that out to make a contrast with other kinds of retail. So these are apparel and fashion driven stocks. Footwear is also into that, and luxury is a little bit considered a different segment. But there's also something called hardline retail or specialty retail, where the products being sold are not they're not apparel and not footwear. And in some cases, it might have a use. And so these retailers can be a little bit more stable. So if I'm thinking about a Home Depot or a Tractor Supply or a dollar store like a Dollar General, these are businesses that don't have the volatility associated with a fashion trend. They can still be influenced by merchandising mistakes, by distribution or other issues or problems, and by what's happening with the consumer from an economic standpoint. But for those investors that find themselves averse to retail, this other component of retail is a lot more predictable from a cash flow standpoint and easier to value, and less about being in the store every single month and knowing what the markdown levels were and whether the weather was appropriate around Easter or not. So I think those businesses can often be excellent businesses. And I would respond to one of your earlier points that it would be a shame to miss out on investing in those kind of companies because they were retailers.
Right. And can you name a few of them that you would fall squarely into that category?
Well, I hit on a few already, but there's a fantastic company in Canada called Dollarama that sells items at now up to $5. And it's a discount retailer, and they've just done an excellent job for a really long period of time. It's an incredibly high margin business. They do an excellent job from a capital allocation standpoint. They return excess capital to shareholders, and they've been growing for a really long time. There's a company that's similar to that in the US that I like called Five Below, that is more discretionary and operates out of strip centers with a low cost from a rent standpoint, selling products at a value basis for a younger customer. But a Tractor Supply or dollar stores or Home Depot, and Lowe's, those are all excellent companies that are definitely investable.
So and I feel like it's just I've this question has been on my mind, and I haven't found a segue, so I'm just going to plunge with it. Retail is supposed to have evaporated because Amazon's doing it all, and if Amazon's not doing it, somebody else is. And we haven't brought up Amazon or online retailers, but to somebody who's a neophyte to investing, because my sense is that you're talking about bricks and mortar retail. Just talk to that. You've got somebody who's, I don't know, and we haven't gotten to the side of your business, which is managing portfolios for clients, but you've got an individual investor who says, hey, John, you're a retail expert. I don't want to go anywhere near retail, or if the only way I want to go near retail is to own Amazon. How do you respond to them?
Amazon has clearly been a disruptive force within retail. There's no, you cannot avoid that. Any retail investment that you need to make has to answer that question. So how is this business positioned for an omni-channel or digital consumer? At this point, I think the businesses that could not adapt have really gone away. So there are a few hanging on that are debatable whether they're going to continue to be around or not. But the majority of the businesses that were unable to adapt to an omni-channel or digital consumer have just ceased to exist. And COVID actually acted as a final washing point to remove these companies, because retailers were forced to close stores.
Yeah.
So if you didn't have an omni-channel capability during that period, you were really out of luck. In addition, it helped to finally, ironically, solidify the advantage that having physical stores gives the remaining retailers. And so why do I say that? Because many years of technology and investments by these companies, which were slow in many cases to recognize what was happening with Amazon, finally came to fruition in offering consumers same-day fulfillment options. And those same-day fulfillment options may, in many cases, utilize the physical store. So Amazon, as you know, I'm sure, has been trying to get faster and faster on delivery. They introduced Prime with the 2-day guarantee. Then they tried to move it up to 1 day. But what retailers realized that they could do is they could remove friction. It's not my favorite term, but people like to talk about friction and removing it, of things like, okay, Amazon delivered the package to your door, but you're not there when it arrives, and you don't live in a place where you have secure place for a product to just sit there, so it's a stressful experience. Or the product arrives and it's not the right size, color, whatever. So then you have to return it, which is painful. You get it, or some other issue with the delivery experience, or it comes the following day. But Target and Walmart found a way so that they can make that product available to you on the way home from work. So when you arrive at Target's parking lot and they bring the product out and put it into your trunk or hand it to you, you can verify at that moment that it is the right color, that it is the right size, it is exactly what you ordered. And if not, you can do something about it right at that moment. Or you could go into the store and augment your trip by adding additional things. Amazon can't do that. It doesn't have a network of facilities that have people who are customer facing all around, that are already existing all around the US. So companies like Dick's Sporting Goods, Walmart, Target, they really leaned into this and developed this capability during the pandemic. And I think has created a kind of an answer to Amazon's consumer offer and leveled the playing field a little bit and utilized the store as an answer to that. So you've got omni-channel retailers that have responded now with something utilizing the store to aid against Amazon. And then you have other retailers that maybe are selling their own brand. So if I return back to Lululemon, Amazon doesn't have the Lululemon brand. So when the customer wants Lululemon, they can't go to Amazon, they can only go to Lululemon in that vertical. Or one of the harder things to work was definitely like experiences. But some products, or I think value, like the customer that really needs it at the lowest possible price, isn't a Prime subscriber, isn't paying for that subscription, doesn't want to pay a delivery fee. And then lastly, there's a customer that I like to talk about that I think Wall Street people sometimes have a difficulty of understanding. It's the customer for whom money is more important than time. And so what I mean by that is they are willing to go to a store and spend a lot of time looking for something that they can buy at a discount to save a few dollars. Whereas I think many people who work in finance are the opposite. They would be more willing to spend extra money to eliminate the trip. But that other customer segment is a real customer segment. So when you're looking at across the retail landscape, you have to answer that question. How does this company compete with Amazon? What is about their business model? Do they have a legitimate offer? Do they own their own brand? Do they have private labels in the stores? Can they give something to the customer that Amazon can't?
I think that a part of what comes up for me as you're saying these things is that in all industries, including retail, the landscape is far more complex and complicated than we can imagine. But what tends to happen is that there's a narrative that emerges which kind of dominates. We were talking about how, there are trends. We talked about Chico's a little bit, and we talked about Abercrombie and Fitch. Well, there are trends in thinking in the investing world, and those trends, there's a narrative that takes over. Amazon is killing all stores, and the reality is far more complex and complicated. And in a certain way, what you do is you identify a divergence between the dominant narrative and what's actually going on the ground. which is complex and diverse, as you're identifying in all sorts of ways. I'm curious to see how you react to this. So I got to know somebody recently whose business is taking returns from manufacturers and possibly retailers and monetizing them in some way or other. And he was telling me that the volume of returns that are generated by all these retail stores is kind of quite enormous. And there are different policies. So if you're a brand like Nike, then they actually will only, so often once a product is returned, it's not economic for that product to be put back on the shelves. So it will tend to have to be either, or at least not in the store it came from. If it's a high value brand like Nike, Nike will often seek to destroy the product, and they will only pass the product on to somebody they will take photographs of the product burning, because they don't want their highly valued products that might have shown up in the Nike store in New York City showing up elsewhere. Then there are other brands with policies that might include relabeling the product. And often these products show up in, Latin America or African countries. But it was sort of shocking to me as well. He said that one of the most important services that a physical store provides is the capacity to return the product happily and easily. And actually, the capacity to return the product brings customers into the stores. Does any of that kind of correspond to your understanding and research? And would you ever talk to somebody like that to get insights as to what's going on inside the retailers?
So it sounds like he's more of a technology guy. There is something called a jobber also, which is a guy who buys, or a woman who buys excess merchandise, so that a store maybe over-ordered air conditioners, and we're going into fall, and so air conditioners won't sell, but they need to get their inventory dollars out of that, so they sell it to this intermediary, who then maybe holds it till next year and then resells it, or maybe ships it somewhere else. Probably in the case of air conditioners, you wouldn't reship it because it's expensive, a heavy product to ship. But yeah, if I would speak to people like that. I try to always get incremental insights. I mean, there's two kinds of insights there. There's like understanding the functionality, the actual logistical way the businesses are being run. And so I think as an analyst, you want to have a really deep knowledge of all these different pieces. And then two, there's a monitoring element. So, what can this guy tell me about what he's hearing about the market for whichever products he might specialize in? And then is there an investment case to be made around that? My approach is less in the weeds analysis these days, as it is focused on financial modeling and the looking through filings and trying to uncover trends within a business that are either encouraging or troubling, which I can use as part of a longer term structural thesis. And that's one of the reasons I've kind of veered away from apparel a little bit as an analyst, because the fashion component is so powerful and you cannot avoid it. And it's hard to kind of look into the future and know if Abercrombie or Chico's or Lululemon 9 months or 18 months from now is going to have the right product and the right colors, and the weather is going to be good, and there isn't going to be a competitor with a better offer at a lower price, versus if I can find a company that's managing to generate higher sales per square foot by changing their store format, that might have a more durable investment and financial implication that I can advise my clients around or get involved with.
So I find myself wanting to go to art. Before I ask you about China/coffee, I because you're in Paris, I feel compelled to ask you, John. And so Paris for me is the center of the luxury goods industry, and I've been reading books by a French professor of business called Sapfer, who kind of is, for a while at least, was the expert, it seems, in the luxury sector. And it's exemplified by brands that are headquartered in Paris, like Louis Vuitton, Moet Hennessy, and Hermes, which is a publicly traded company, which trades at a phenomenal 13 times revenues and God knows how many times earnings. And it's something that it seems like French companies are experts at. Is that, and just to give one other example, it's not a publicly traded company, it's a family-owned business, and it's just fascinating to follow these things. So in general, for those who are listening to this podcast or this conversation, I don't know any European, or for that matter, many American women from the Northeast who would buy a Louis Vuitton handbag with the Louis Vuitton logo on it, because it's kind of almost crass. But I know I see the stores when I'm in Paris and elsewhere with Asians lined up to buy that. And Capfra tells me that these products have to be manufactured in France because otherwise it's not authentic. There's a family controlled business called Goyard. Goyard also makes handbags. They have a pattern that is unmistakable, and that is kind of the un-Louis Vuitton, and it's making extraordinary progress and is an amazing product. I find all of that fascinating. And once I got the insight, just going back to an earlier part of our conversation, John, in which, those of us who are analytical, who don't believe that the advertising affects us. Yes, it definitely affects us. These trends affect us. I was aware of Abercrombie and Fitch, even though I hadn't been to a store. You can go on and on about it. I think those effects are even more powerful when it comes to the luxury sector as opposed to the apparel sector. And you happen to be in Paris. Has that ever been of any interest to you? Do you have any special insights to share, or anything that you want to contradict in what I've just said?
I might have to disappoint you here. I don't know if I haven't ever spent a ton of time delving into the luxury space. I did follow the Swiss watch segment for a while, but it was quite some time ago. And it just, those brands have an incredible heritage and it's super powerful. You can't really dislodge them. And they seem to be excellent at maintaining their appeal. You're right about Louis Vuitton and LVMH. I believe their largest market is China. And so it's not just Chinese tourists coming here and waiting in line on the Champs-Élysées, as you said, but they actually the stores in China. Maybe that makes it less attractive to some US or Western consumers, but I don't think so. I think they're still selling plenty of handbags to women in the Northeast, as you mentioned, and other places. These are great brands. They're unique properties. You can't have nobody's building new 100-year-old brands.
And before we move to China and or coffee, another sector which you're very close to is, France has a kind of, I don't know a lot about it, but France is different geographically to, say, the United Kingdom or Germany, in that it's a very spread out place. There is actually a lot of space on the edges of towns for what they call in France grand surface, big surface stores. There's a company that a classmate of mine from business school followed for the longest time, who kind of excellent retailers, called Carrefour, which is a publicly traded company. There's another one that when we're in France, we go and buy all our sporting gear in, called Decathlon. And you can't have spent more than a week in France without walking into Decathlon. And we all learn to love it. It's a fantastic place. I don't know if Decathlon's publicly traded, but you're so close. Does that ever appeal? Do you ever decide that you want to delve into that and talk about those businesses to your client base?
Okay, so that's a great question. So I do occasionally have clients that want me to do work on European retailers. I am doing a bespoke project for one client right now on a chain of fitness gyms. But unfortunately, my expertise is 20 years following these US-based companies. So it's hard for me to transition from one to another very quickly. I also have a bandwidth issue, which is how many companies can you follow before you've diluted your ability to be on top of everything and to add value. So I am interested in European retailers. I have been in those stores that you just mentioned, the French stores. I would need a client base that would care. So I think where it would be valuable is if I found a business that I was convinced was a really excellent company and was unknown, and I could pitch it with a lot of conviction and emotion, then my clients would care. I haven't really encountered something like that yet. Large French retailers are probably would not be my favorite hunting ground, based on some of the labor dynamics and cost structures here in France. They have things that are unknown in the US. For example, they have rules about when you can have a sale. So retailers can't just have a sale whenever they feel like they have too much inventory. They're only allowed to have a sale during a specific period of the calendar dictated by law. So there's just a much, they're more controlled in terms of how they can run their business. That doesn't mean that they can't be great businesses or that they aren't great retailers. It's a different set of operating environments, and I'd have to really familiarize myself with all of those things.
Yeah, I hear you. So I also want to ask you about the client portfolio side of your business, but at ValueX, you presented some ideas on this Chinese coffee company, and I'm curious. So you're willing to analyze Chinese companies from the perspective of from sitting in France. Tell us a little bit about how that unfolded. Where did you develop the confidence to dive into that part of the world? Okay. And then maybe if you want to share a little bit of the insights that you shared about this Chinese coffee company. I don't know if you do on this audience, but if you do, you're welcome to.
So I'm super fascinated by China. And ironically, sitting in Paris, I'm 6 hours behind Beijing and I'm 6 hours ahead of New York. So there are Chinese companies, there's about 250 Chinese companies trading on the New York Stock Exchange, there's a debate about, there's some issues about that right now, which I'll leave aside for the moment. But if you want to follow a Chinese company for a US investor, actually being in Europe is a pretty good seat because I can talk to them in the morning in China, and then I can talk to my client in the afternoon. Whereas if you were in Hong Kong or New York, trying to get that call in is very painful from just a logistical standpoint. Now, why is China super fascinating? Well, because it's kind of a counterexample to the accepted wisdom about how to run an economy. So we've been taught, I think, that the capitalistic model is the only model that allows value creation from an economic standpoint. And the counterpoint is, the Soviet Union. So we look at what happened with the Soviet Union. You say, look, this system didn't work. The only system that works is this free market capitalist system. But then if you go to China, it's not a free market capitalist system, but they've created this incredible economic engine that's brought, 1 billion people out of poverty. So I think that's very interesting in and of itself, that this is a counterexample to the accepted wisdom that we're taught in the US. Another thing that's super interesting about China is that they didn't have a PC era. So if you think about the technology trends that happened in probably in the 80s and 90s, there was the PC revolution where people got computers and home computers and businesses were done on computers. And then later, we moved to smartphones. But businesses are dedicated to continuing to monetize their investments in the PC infrastructure. So they're actually disincentivized to let people move on to the newest, greatest, more efficient thing. In China, they skipped that piece. So they didn't really ever have a PC revolution, at least from a personal computing standpoint. And so everyone went directly to smartphones. And so as a result, the innovation around smartphone use, especially around payments and so on, was unfettered by these restrictions and business practices that were designed for large technology companies to continue to monetize their existing platforms and investments. So you have, in some ways, society, I think most people would agree with this, was more advanced from a technology standpoint than the West in terms of some elements of how they're using technology to do things. And so that's super exciting, I think, for me to go see. And then lastly, you want to, as an investor, get exposure to this kind of a market. It's an enormous market. It has growth. It's not mature like the US market. It's not as competitive in an entrenched way. So the question is, how can you get exposure to this exciting, huge, enormous, growing economic revolution in a way that it reduces the risk profile of the investment, that doesn't expose you to bad actors, to fraud, that to the Chinese government doing something that might have a negative impact on your investment arbitrarily, and where you can believe the numbers and understand the business. And so my approach has been, you can do it by going through Western consumer brands that operate in China. So for example, one of the companies that I follow is Yum China, which operates KFC and Pizza Hut. They're the largest restaurant operator in China with over 10,000 locations. I kind of consider, and it trades on the New York Stock Exchange. So I kind of consider it like a China light investment. So because you can understand the business, they report in English and in US dollars. It trades on American Stock Exchange, also trades out of Hong Kong, but the business is 100% in China. So that allows you to get there with removing some of these layers of distrust and potential for misunderstanding the situation. Coffee, since I followed Starbucks for a long time, is just a really understandable business. It's a simple business. Selling coffee in a store is super profitable. It's a flavored water. You don't need a lot of equipment. You can sell it at a high markup. And I've looked at numerous businesses like that in the US, and they generate very attractive returns. And I've been to China with Starbucks to visit their stores and see what they're doing there. So along came this company, Luckin Coffee, which listed also in the US on the New York Stock Exchange, but was a growth story selling coffee in small stores in China, but with this very interesting technological story behind it, that basically you had to do 100% of the transaction through an app. So they don't accept any cash. They control all of the inventory on the app. The apps were also designed so that if, for example, a product was expired in the store, it would not, the store attendant wouldn't be allowed to sell it. It wouldn't be able to be rung up by the register. And there's an advantage of running everything through an app like that, which is you can control and understand, who all your customers are, how frequently they come, what your expense levels are, you can plan the store. It was exciting. But when it came public, they had it was a huge valuation. I think at one point it was trading at $11 billion market cap, which was more than Domino's Pizza, which has, decades of experience and is the largest pizza brand in the world with, I don't even know the number, let's say 30,000 locations. So for this startup coffee company to be getting the same valuation as Domino's Pizza just didn't make any sense. And unfortunately, what it turned out was that, the numbers weren't real. So the stock crashed. It went down 90% in one day. And I thought it was probably, going to zero. But all the analysts who covered it dropped coverage. And so I continued to follow it and keep up my model and pay attention to what was going on because, and it was based on a lesson that I learned from Steve Madden, which I referenced earlier. When Steve Madden was arrested for working with the Stratton Oakmont guys, all the analysts dropped coverage. Steve Madden, if you pull up a chart, has been an incredible home run. It has been a massively successful investment. And what I learned from this situation is that sometimes when everybody else won't look at anything and they all abandon a stock, that's when it becomes the most interesting. And so that is the situation right now with Luckin Coffee. They've removed all of the bad actors from a management team. They've replaced the auditor. They came out of bankruptcy. They raised incremental capital. They fixed the balance sheet. And they're actually performing really well. And it's about a 2 billion market cap right now, I think. And really no one's paying any attention to it as far as I know. So I have incredibly detailed financial model on the company. I think that from a value investing standpoint, this is one of the places where you can potentially get a legitimate edge is by looking under the rock here where nobody else is willing to go, and doing more work in a space that has been neglected, so that you can therefore have conviction about what you think the value of the business might be. And then you look for whether the market is correctly representing that value or not. So I think this is an interesting idea. The company is doing really well. I enjoy following it and talking to the management team. And I'm looking forward to the chance to go back to China to see their progress. And there's some other upcoming Chinese companies that I'm interested in as well.
And just, we could dive all sorts of things into Luckin Coffee, which I don't know all that well. Just who's behind it?
Well, the original guys that were behind it are now no longer involved. But there is a private equity firm that has more than 50% voting power called Centurium Capital. And I don't think I can speak to the background of those individuals, but some of them have worked also in the West. So they helped to provide incremental capital for the company when it was recovering from the fabricated transactions that they reported, and helped them to shore up the balance sheet, put new systems in place, and now they're on the board. So they have a controlling stake. So what their plans are not entirely clear, but so far they've been a very virtuous partner with the business. So I imagine with their investment, which I estimate may have been as much as $500 million of capital that they put into the company, that they wanted to succeed.
So thank you for sharing. And obviously, anybody's listening to this who wants to engage with John, we'll give at the end ways to get in touch. He's got a very nice website, which is obviously a place to go. Last place that I want to go with you is, I'm curious to hear about your client portfolios, your experience of transitioning or engaging in the transition. You were on the buy side, you're doing a research product, but you're also willing to run money for clients I'm curious to hear how that transition is going, why you came up with it, how you deal with questions from clients or prospective clients about potential conflicts between your research business and your investment management business, where you think you'll end up in 10 or 15 years. I would tell you, for your interest, John Miljevic, who runs the Manual of Ideas, I've often asked him why he would not transition into running money for some of the many admirers that he's got. And he just smiles cryptically and says he's happy the way he is, but you've taken a different path. I'm completely on the buy side, but I'm curious to hear about your transition and what your thinking is.
Okay, a couple questions there. I should mention also that any stock I'm talking about here is not investment advice. You need to get your own advisor to tell you what to do.
Did you hear that, everyone? Loud and clear. Any opinions expressed on any companies are just opinions, nothing more, nothing less. That should be sufficient, John.
Thank you.
Regulators.
So I think originally people approached me occasionally over the course of my career asking if I could manage some money from them, but I was unable to in my former role as sales analyst. So when I started this business, I put a structure in place so that I would have that capability. And I think I would actually, and so basically I'm managing money for others in the same way I manage my own capital, which is with a very long-term compounding objective, owning high quality companies bought opportunistically that I think can deploy capital at a high rate of return over the long term. I enjoy doing that. That's fun for me. So I felt that if I can actually build a business around something that I would do if nobody paid me, that would be just fantastic. So that's kind of how I've thought about it. From a conflict standpoint, I have a restricted list. I cannot invest in the same companies I write about for my research clients. So therefore, it just stays completely separate. There's plenty of companies for me to invest in. There's maybe 40 companies that I write about for my research clients. So those names are off limits.
Yeah, interesting. And so last question for me, or a couple of last questions. I want to go back to Paris, and in a different version of my life, I might have lived in Paris for the rest of my life. For your interest, we moved to Switzerland, my wife and I, with young children, and now our children are kind of just pre-university age, and they are free to, as adults, to do whatever they like, and as parents, will support them. But there's a slight sense of sadness for me that so far none of our children have expressed interest in studying in a European university, whether that's the UK, Switzerland, or elsewhere. They were all born in New York City. They all want to study in American universities, and I can't fault them. It just saddens me because I'll see less of them than if they were over here. And I'm curious what that looks like in your family, because obviously you have a strong tie to the United States. You grew up there. You study companies there. I'm curious how your family will evolve in a certain way. You're a global family. You have serious business interests now in China as well. You're in a good time zone, but do you have any, what do they call about it? They call it in the financial world, it's like, not color, but sort of like any kind of, what do they call it? I can't remember. Sort of more clarity on how your family will evolve is something that's interesting personally for me.
Well, I'm a little bit ahead of you. So my two daughters were also both born in New York City. And so I have one who just finished her first year of college, and she's at Tulane University in New Orleans. And she's loving it. She's having a great experience there. I think one downside is that it's really far away. And she's not able to kind of come home on all the breaks. And it's not easy for us to go visit her. You know, when I'm in the US on business trips, she complains that I'm not visiting her, but New Orleans is not exactly close to most of the places that I go. And it's a big country, as you know. My second daughter, I think, is more likely to stay here in Europe, probably the UK. So she's a junior right now. So I think she's looking at London.
That's interesting. So we'll see. We'll compare and contrast. Very lastly, John, if somebody does want to engage with you either on your research service or on the portfolio management process, I mean, obviously you have a very good website, but are there any thoughts that you want to share with them in this podcast?
I do have a monthly newsletter where I talk about a stock pick and I discuss my view of what's happening in the market. The point of the newsletter is to communicate in a non-jargon way what I think is happening in the market. I usually try to work something out for myself, and so I would encourage you to subscribe to that to get a little bit more information. But yeah, you can get to me via my website, and I'm here. I like talking to people, so I'm totally open to incoming requests.
And other than the fact that he lives on the wrong side of the Seine, on the right bank rather than the left bank, he really is a lovely guy. So, John, thank you so much for joining me for this conversation.
Guy, thanks for inviting me. This has been really fun.